Welcome to Intermediate Macroeconomics. I'm Dr. Dangerous Dave, and we're going to break down fiscal versus monetary. In the aggregate demand shock video, we looked at positive and negative demand shocks. In the aggregate supply shock video, we looked at positive and negative supply shocks. Now we'll take a look at the possible policy responses to demand and supply shocks. First, we have to build an impenetrable wall between fiscal policy and monetary policy. Just how impenetrable that wall is varies from country to country and even from time to time within a country. Still, we find it useful to think about the government and the central bank being completely independent. Fiscal policy is what government does. It can include many things and have many goals, but we'll focus on just 3 fiscal policy tools and one goal. The goal? Reduce the pain of recessions and limit the inflationary pressure of economic booms. There are certainly political aspects to this goal. For example, reducing the pain of a recession may be a way to forestall social unrest. Cooling down rapid growth may be a way to pay down debt incurred in previous recessions. Here, we'll concern ourselves with just the economic goal of stabilization policy, meaning stabilizing the economy when it swings away from the natural level of output. If you're uncertain about the meaning of natural level of output, see the aggregate demand shock video. To be sure, there are theories of macroeconomics that posit that government has no role in the economy, or at least no responsibility for economic stabilization. Research those ideas if you're interested. Here, we're going to assume that government has a role in stabilization. Now, fiscal policy. The 3 tools of fiscal policy are government expenditure, the G in the national accounts relation, Y equals C plus I plus G. Taxation. This is government's source of income, T in the public saving relation, S equals T minus G. See the video on equilibrium in the market for loanable funds for a refresher. The relationship of T to G is the principal policy choice in stabilization policy. Deficit spending, that is G greater than T, happens whenever income goes down because tax revenue goes down, and this is one of the automatic stabilizers. Tool number 3, extended unemployment benefits. While payment of unemployment benefits increases during an economic downturn without intervention, that's the other one of the automatic stabilizers, government often provides extended unemployment benefits during deeper recessions. The 2 automatic stabilizers I mentioned, unemployment benefits and deficit spending. In a recession, when unemployment is increasing, the number of households relying on unemployment benefits increases. These households have higher consumption than they would without the benefits, increasing aggregate demand or at least slowing its fall. Deficit spending arises because in an economic downturn, taxes, which are typically a percentage of household income, go down, but government spending, G, is fixed in the short run, so it does not go down in a recession. Thus, in the beginning of a recession anyway, government spending becomes a larger fraction of GDP. Subsequently, it is government's decision whether to increase government expenditure, which is called stimulus spending, or have the government contract along with the economy. This latter choice, for the government to contract along with the shrinking economy, was the preference in the United States during the early years of the Great Depression, and most economists agree that it was a very bad decision. In subsequent recessions, increased government spending has been a principal component of fiscal stabilization policy, and it has turned out well for the most part. Still, there are those who disagree, and I suggest you research their points of view on this. In the case of a recession brought on by a drop in consumer spending, an increase in government spending can lessen the impact. If increased government spending can keep prices from falling, that is, avoid deflation, consumers don't have a reason for putting off major purchases, preventing further downward pressure on aggregate demand. The second tool of fiscal policy is taxation. In an economic downturn, the government can also increase deficit spending by lowering taxes. This form of fiscal stimulus is popular in economic sectors that don't generally benefit from stimulus spending. Tax reductions have a smaller impact on aggregate demand than direct government spending, as we'll see in the Fiscal Policy Multiplier video. In order to accommodate the diversity of opinions regarding the role of government in stabilization, most stabilization programs incorporate both increased government expenditures and reduce taxes. The third tool of fiscal policy, extended unemployment benefits, does not play as big an economic role as spending and taxation, but it is popular in times of persistent unemployment. In macroeconomic terms, extending unemployment benefits beyond their role as an automatic stabilizer has the benefit of increasing household consumption at a time when it is most important to economic recovery. Now, monetary policy. Monetary policy is what the central bank does. That would be the Federal Reserve, or Fed, in the United States. The autonomy of the central bank varies from country to country, so assuming true separation of fiscal and monetary policy is more theoretical than real. In economies with a high degree of central bank autonomy, the Fed in the United States or the European Central Bank, ECB, in the Eurozone, the central bank tends to be an extension of the banking industry. That means that while the central bank can implement monetary policy without government interference, as in the theoretical model we'll explore here, the central bank may be influenced by the interests of the banking industry. Those interests are probably not in conflict with the stated goals of the central bank most of the time. However, during an economic crisis with roots in the banking sector, such as the Great Recession of 2008-2009, the central bank may be pulled in different directions by good monetary policy versus good banking policy. Both the Fed and the ECB have faced this criticism. Before we get to our simple monetary policy model, you should take a moment to review the Money Multiplier cartoon and Money Multiplier math videos. In particular, we'll be using the Money Multiplier relation, where the big M is the money supply, the little m is the money multiplier, and big B is the monetary base. The Money Multiplier is defined where CR is the currency deposit ratio and RR is the reserve ratio. We'll look at three tools of monetary policy and one goal. The goal is to maintain inflation at 2%. The tools are: 1. The monetary base. The central bank has direct control of the monetary base. 2. Reserve requirements. The central bank, as regulator, sets the minimum reserve requirements for banks. And 3. Interest rates. The central bank has indirect control over interest rates through interest rates charged to banks. In the United States, the Fed controls the monetary base through open market operations, that is, transactions with banks to buy and sell bonds. When the Fed buys bonds, the money the Fed uses to pay for the bonds increases the monetary base. Conversely, when the Fed sells bonds, the money the banks pay is taken out of the monetary base. Reserve requirements are a seldom used tool, much more effective in lowering inflation than increasing it. In principle, the Fed could reduce the money multiplier by increasing reserve requirements, thereby reducing the money supply. While this might be effective in reducing inflation, the time to implement it and the fact that not all banks are subject to reserve requirements make it a cumbersome tool. More recently, the problem has been banks holding excess reserves, reserves greater than they're required to hold, which has kept the multiplier small and inflation too low. The central bank, as banker of last resort to commercial banks, can influence interest rates by setting the rates charged to banks for loans. In the United States, the discount rate is the interest rate the Fed charges to banks. In 2008, the Fed began paying interest on reserves held with the Federal Reserve. This is another factor in the high excess reserves that have resulted in a very low money multiplier ever since September 2008. Now, about stabilization policy. In a recession, when aggregate demand falls, the intent of stabilization, fiscal or monetary, is to put upward pressure on the AD curve. A fiscal policy of stimulus spending, for example, is intended to lessen the fall in GDP and subsequent increase in unemployment. This plot shows a fiscal spending stimulus that only partially compensates for a fall in consumer spending. In this plot, a fall in consumer spending is partially counteracted by an increase in government spending. The net shift in GDP is lessened, deflation is lessened, and the time it takes the economy to return to Y-bar is shorter. Fiscal policy takes time to design and implement, especially if it involves cooperation between branches of government. Furthermore, the cost of a stimulus package that completely replaces the lost expenditures from both consumption and investment would far exceed the benefit. These factors make fiscal policy an inexact stabilization tool. The effects of a monetary stimulus would be similar. For example, an increase in the money supply may restore spending by firms and some consumers. This tool is even more inexact than the fiscal spending tool, since it relies on the preferences of firms and banks. The unwillingness of banks to make loans following the 2008-2009 crash was one of the factors contributing to the low effectiveness of monetary policy. A fiscal or monetary policy intended to increase the GDP, as in the preceding examples, is called an expansionary policy. Conversely, a fiscal or monetary policy intended to reduce the GDP is called a contractionary policy. Such policies might be enacted to reduce inflation during a period of rapid growth. Consider the period of rapid growth during the dot-com bubble of the 1990s. As the United States economy grew rapidly, a reduction in fiscal spending simultaneous with a reduction in the money supply kept inflation low. The reduction in government expenditures during this time had the added benefit of giving the United States its largest budget surplus since 1948 and its only budget surplus in the last 46 years. Strong separation between government and the Fed meant fiscal policy and monetary policy were decided independently. But it didn't hurt that both parties made their intentions clear and followed through on their promises.